Welcome back to Inspired or Acquired. This is the podcast where we interview real business owners, talk real numbers, and ask them whether or not they would sell their business. I'm one of your co-hosts, Patrick Dichter from Appletree, joined today by Clint Fiore, other co-host from Dealonomy. He is our mergers and acquisition specialist. And our guest today is Brandon Hall. Brandon has an amazing story of building Hall CPA from the ground up. And he is truly a pioneer and an inspiration in the accounting space. So we're going to hear all about his business today. So Brandon, how are you today?
I'm good. I appreciate the kind words. Thanks for having me on the show.
Yeah, man. I'll just jump right into it. I sent Clint the show notes and I was like, Brandon is like the GOAT of running tax firms. So that was how I prefaced you to him. But for people who don't know that you're the GOAT, tell us a little bit of about your firm and who your clients are and what it looks like today.
Yeah. So I started my firm, I guess technically I started it in 2015. I think I netted like $4,000 that year. I went full time into it in 2016. I was working at EY at the time, September 2016. So from September 2016 to now, I've grown the firm to, I think we'll do about 14.5 million this year. We've got a global team of about 105 or so people. About 55 are onshore, and the remaining are split between Philippines and India. And we exclusively service real estate investors, at least for the time being. We are currently exploring additional verticals or niches to attack through potentially M&A, which is kind of interesting. But we've got about 1,000 or so clients nationwide. Somebody asked me one time, do we only do the real estate piece of tax returns? I was like, well, no, we do the whole thing. But then I was like, oh, well, I guess we're not like totally niched in real estate then. So what's interesting is all of our clients, 100% of our clients are investing in real estate or running real estate businesses. But we end up handling their entire like portfolio of what they've got going on. So we're actually in a ton of different industries and things like that. So it's kind of cool. Yeah, but we provide advisory services, tax advisory services to clients. We provide compliance services and monthly accounting services to clients. The unique thing about our firm, two unique things about our firm that make us very different from other accounting firms. One, three things. One, we've always had a top line growth rate of about 40% plus per year.
Wow.
And that's all organic growth. We haven't done an M&A deal. So our digital marketing platform is just incredible. Two, we don't track time. We measure results. That's how we hold people accountable in our firm. And three is where we are a 100% remote firm. But backing up to number two, when I launched this thing, I didn't want to go into the office. My experience at the Big Four was like, we all dressed up every day. We went into the office and we never saw the client. I was like, we can do this work anywhere. We don't need to be on the client site, was my theory. But then the immediate problem was, well, how do I know if people who say that they worked 8 hours actually worked 8 hours? And then I went back to my experience at EY and PwC, and it's like, well, a lot of us just logged 8-hour days anyway, and we were still in the office and nobody was asking questions. So the time tracking thing just didn't really make sense to me. So I started thinking, well, what does make sense? What is true? And it's a question that I love to ask, even still today. Like I'll ask my leaders, how do you know this information is true? It's a very powerful question. But that was where I started, was how do I know what is true? And what is true is, did the task get done and delivered to the client or not, right? It either did or did not. It's true or false. So I decided to track all results. That's what we've built around, and not track time. But yeah, we're 100% remote. That's our third thing. And that the pros and cons with that, sometimes we get a little lonely working at our desks and out of our house. We do an annual team trip every year, and we always come off that team trip going, man, we should totally get in the office and like work together. It'd be a lot of fun. But the pros to that are we can hire anywhere. And that's a huge competitive advantage for us. So we don't have to move people to any location. We don't have to upend lives. We can, there's a lot of people in the Midwest where their spouse got a job and had to relocate to the Midwest, but there's not a lot of accounting firm opportunities out there. So we're able to pick up a lot of those folks, and it's been very successful for us.
Awesome, man. Pretty amazing growth, all organically as well.
Yeah, it's been fun. Stressful, but fun.
Hey guys, want to take a quick break from the show to thank one of our sponsors and tell you all about them. So Eversight is the company and our sponsor. They were actually a guest on the podcast, and they're somebody that I've used for digital marketing. A couple of things that I love about Eversight. Normally, if you go to design a website and have somebody really do it well, they're going to charge a big 10 to 20K upfront fee, and then you'll get charged hourly anytime there's updates. So Eversight totally flipped the model. They do a monthly subscription that covers great designs and unlimited updates. I use them for my website, and then they can also help with SEO, AdWords, and all your ongoing content needs. They're a great team. They're responsive. I believe in them. I know them. They're a guest on the podcast, so we don't take sponsorship lightly. And I'm a big fan. So I would definitely encourage you to check them out if you've been thinking about beefing up your digital marketing or possibly doing a new website. You can go to eversight.com/inspired and tell them that you found them on the podcast. And back to the show.
So, I've been really excited to have this conversation with you, Brandon. Thanks for being here. I always like to ask first off, just like, what's your family situation? And you seem kind of young. Are you 30s, 40s? What's your age and family situation?
Yep, I'm 34.
Okay.
So that's going to play into the whole buy-sell conversation or sell-hold conversation we're going to have here in a minute. But I'm 34. I've got a wife and 3 kids. I've got a 5-year-old, a 3-year-old, and a 4-month-old. So, yeah, it's crazy.
Awesome, man. Congrats.
Thank you.
That's like the maximum parental energy time right there.
It's a lot. Yeah. You know what's funny is my first one, James. So I've got James, Rosie, and Eloise. James was hard for me just personally to transition from like independent life to dad mode. Rosie, our second, was super simple because we were already in like diaper mode, and it would just, Eloise, she's great. She's simple, but my 5 and 3-year-old have like unlimited energy, and they're also extremely competitive with each other. So they just fight all the time. Mm-hmm. So now we're playing like zone coverage, my wife and I.
Yeah.
And that's been exhausting. Yeah. That's been hard.
Yeah. Well, awesome, man. That's love those years. It's a great time. So you're 34, you built up this amazing company. I love your business model. You did 12.3 million last year. It sounds like you're 14, 15 potential this year.
Mm-hmm.
What does your cap table look like? Do you own this thing 100% or do you have partners?
I own roughly 89%.
Okay.
Yeah. And I've got 4 partners who split the remaining 11.
And when did you start it?
2016.
Okay. So you're 9 years in, man. That's a phenomenal growth rate. Hats off to you, man. You're really killing it with the growth, with the organic growth. And I love the scalability of your model. And just as a client, a customer of these things, I think it's a win-win for your team, but also for the clients. Cause like I also get annoyed by hours, and I would rather just pay for results and getting the work done that I need done. So I think you're onto something here. I think you've got something to offer this industry that's special. I think that's really cool. So I want to jump into what our favorite part of the show is here, which is kind of just diving into the numbers, getting to kind of a ballpark of what this company may or may not be worth. And so we can ask you the money question of would you sell or would you not? So at 34 years old, I actually think that Patrick and I are very qualified on this one to give a value opinion, because Patrick's in this industry and he does acquisitions, and I'd love to get his opinion. But I also have one of my closest friends has a similar hybrid distributed accounting company that's very similar numbers, and he's currently entertaining offers. And I know exactly where those offers are coming in because I'm kind of looking over his shoulder as he navigates this space. But there's this really competitive acquisitions mode going on right now in accounting firms of your size, because the whole industry is kind of bifurcated. It's like there's a lot of big players and there's a lot of really tiny ones, but there's not very many mid-sized ones. So where you're at is extremely in demand, because there's just not many acquisition opportunities to get one that's doing, I would say, multiple millions of EBITDA that is still like but is still small, privately held, independent like yours. And so if we're just to say where you're at, maybe on a trailing 12 basis, I'm going to do some rough math based on the margins you told me and say,
Sure.
let's say you're at like 13 million ish. And if you're running, you think you might be 20% adjusted EBITDA margin, like something like that, 20, 25?
Well, it kind of depends, right? Like it depends on who's staying on afterwards.
Yeah. So let's add up like your EBITDA plus your comp package to give us like kind of like an owner's benefit here.
So yeah, probably about 20%. Yeah.
Okay. So that would put you, roughly 2.5 to 3 in terms of adjusted EBITDA. So like probably at least 2.5 mil. And my friend that has a similar size company, he's over 2. I think he might be just right there, 2.5. Like, I mean, the numbers are very remarkably similar. And these are conversations he's having this month. So like this is very fresh.
To merge? Wait a second.
Very fresh data. He's getting offers at 10x or a little higher, which really surprised me.
That is surprising.
And so I feel like we could go to some of those same people that we have access to from that are talking to him. And if you were like, Clint, I just want time with my little kids and I want out, and I think I've had a 9-year run and this thing's ready to go to the next level, rather just kind of like do something else with my life. And if you were to have that conversation and call me, I would tell you, after I looked at the numbers, I'd be like, you're going to get probably at least 20 million and could be as high as maybe 30. But I would say like most likely sales price would be like that 25, 30. And for you owning most of this thing and as an 89% owner, and do you have debt on the company or anything like that? So no debt. You started this thing from scratch, made $4,000 your first year. I mean, that's got to be a little bit eye-popping, right? To think that, man, I just started this thing, no plan to be at where you're at valuation-wise today this quick.
Yeah.
I mean, if I was to bring you a $27 million check, could that tempt you at this point as a 34-year-old family man? Or like, how would you respond to that?
I think 27, I mean, I obviously haven't shopped around to the degree that you have the data. I think 27 would be high. But maybe, I don't know. I mean, we have a really incredible growth story, and we're 100% remote. The business does not really need me. I've built a really incredible leadership team. So maybe it would go for something like that. I don't know. I mean, I think if I was like 45, the answer would be yes. It'd be a no-brainer, and I'd be done. But I'm not there yet. And I think that we've got a lot of cool stories that we can continue to tell here at the firm. I want to do some unique things with equity and pull people into equity earlier than you might see otherwise in the industry. And so I think that there's still, I still have a lot of gas in the tank to try to break some things in the industry. My goal was to scale it to about $10 million of EBITDA and then figure out what to do. I actually thought that's where you needed to be to get the 10, 11, 12 valuation. So to hear that your buddy's getting a 10 valuation on,
I was in the same boat. That's what I thought too, until I saw it with my own eyes in the last few weeks. Like, this is very fresh to me, because I thought he would be in the like maybe the 5 to 8x range, not the 10 to 12x range. But again, it's like there's some major well-capitalized players that are doing big moves in the space, and there's not very many firms for them to go after. And so it's super competitive.
How long do you think that continues? That type of valuation continues?
So this is what my friend's wrestling with. And this is what I wanted to unpack with you is like, here's his thought process. And I want to hear your response to this. It's like, on one side, part of why he's been so successful is because he was ahead of the curve with the offshoring, and he has a hybrid model too. Probably similar amount of employees, about half are US and about half are overseas. And so they have a distributed remote team, and the companies that were early adopters of that trend and really built those agile, scalable organizations have done really well. Like y'all's firms are very similar, but there's this whole other, there's two dynamics. There's one is, I feel like these are kind of peaking valuations.
Yeah.
And he's wondering if I keep growing this thing and sell it in 5 years, and instead of doing 2.5 million EBITDA, I'm doing 5 million EBITDA, but the multiples are now down to 6, 7, 8 again. I end up selling for the same amount of money, and I just had to work twice as hard to get it, and so that's why he's thinking about maybe I should do this now. And the second big element is he's thinking about the role of AI, because you've got AI kind of poised to be a disruptor in this industry, just like offshoring was. And I feel like you've got a fork in the road of, you can either sell now at a crazy valuation and let someone else worry about how to deal with the AI encroachment on your space, or you can double down on it again, like you did with offshoring as an early adopter, and be like, and just ride that wave to another level of profitability and success by really being a strong early adopter into that space. And how can it benefit your clients and your team to do more with less with this great new technology available? And so you kind of have to ask yourself, like, do I want to reinvent myself and ride that wave, or do I want to like cash out now at this big value? So I'd love to hear your response to kind of like those two things, the timing of the peaking of the multiples and also the impact of AI on your industry.
Yeah. So the timing of the peaking of the multiples, I think that I entertain a lot of private equity offers on a pretty consistent basis, just to kind of see what they're thinking and to talk with them and get additional data points for myself. And the general thinking is that this M&A type activity is going to continue for many decades in the accounting space, because it's just so fragmented, and there's always going to be firms like mine that kind of come up and hit the 10, 12, $15 million revenue number that are ripe for the picking. So I don't know how that necessarily impacts multiples, but I guess I say that to say that I'm confident that I'll be able to sell it at some point, and I'll be happy with whatever that number is. Like I don't see myself 5 years from now going, man, I should have sold back in 2025 when they were 10. I see myself 5 years from now going, cool, now I'm running a $30 million firm. And I've got an incredible executive leadership team that is doing 95% of the day to day, and I'm only focused on the fun stuff, and I'm getting paid what I want to be paid to have built this asset over these years. That's a pretty appealing position to be in too. Like, just not even a sale type position, but just now my role is primarily allocating capital and networking, right? It's finding additional M&A targets, and just stacking them on to the firm and continuing to grow the top line. Like I could genuinely see that, as long as this is fun for me, and fun is subjective and kind of changes based on the season, but as long as this is fun for me, I don't really have any interest in selling. Like I could see running this thing for a really long time, but one of my, I think, superpowers is finding great people at this leadership type level and coaching them and enabling them to be successful. If for whatever reason I stall out on that, that will all of a sudden become less fun for me. So that will not be good. But yeah, anyway, back to your question on the valuation multiples. I don't know if this is peak. I mean, you probably know more than I do. I would trust your opinion more than I would trust mine.
I don't know if it's here to stay or not. I try not to fortune tell too much, because every time I try, I'm always wrong about that. So, but I just do know we are at in some of these sectors, and I would say accounting and the mid-sized accounting firm space is probably at historical highs.
Yeah,
and so that. There's two ways to interpret that. It could mean that we're peaking and it's only going to go down, or it could mean that like we're just here to stay, and we're going to keep growing. And so I don't know.
People thought plumbing and HVAC was going to slow down too, you know?
Yeah.
And I'm over the house.
Yeah. I think it's just because it's so fragmented. It's just so fragmented, and accounting is the Patrick, did you just tweet this? I think it's like the bedrock of, or it's the, what did you just tweet? You just tweeted, it's like, yeah, I was
There
like,
was
yeah,
an
exactly.
article where they said accountants aren't as like, they don't have the swagger and panache as investment bankers, but they're the heroes in M&A.
Yeah.
Is the article that I shared. Yeah.
Yeah. And I think that'll continue. And so your question on AI, like that's a big question I've been pondering too. I think that, I think AI is going to be very disruptive. I think that, and I could be very wrong, to be clear, but I think that a lot of these like really small firms are going to feel the pressure very fast because they just don't have the bench of competencies to service a client more holistically or have that deeper expertise. And so they're going to have to join like an alliance or something to gather to be able to holistically service their clients. Otherwise, their clients are going to go with somebody like a TurboTax who has a crap load of money to spend on AI, right? You've already seen TurboTax move upstream client-wise. They started with just a little DIY software, but now they're preparing your entity tax returns for $2,500. Well, who's going to win the cost battle in acquiring clients, right? Who's going to be able to acquire clients more cheaply at the end of the day, or just more clients? Is it going to be TurboTax, who can invest hundreds of millions in AI and figure out how to really do that effectively, or is it going to be like the smaller like firms that are out there? And I think that the answer is it's going to be TurboTax, right? Not to say that people don't value relationships, they do, but the reality is that more and more people are getting more and more comfortable with technology. And if the technology can DIY 90% of it, then I think you're going to see a lot of disruption. So what we're doing is we're looking at adding those additional competencies right now and moving upstream client-wise. Not to say that we're ignoring the downstream clients. We're not doing that, but we are trying to figure out how to service them more holistically so that when AI does come upstream, the client has to make a decision between, do I want this relationship or do I just want the cheap output? And I think everybody will make that decision differently, but I think that's where that disruption will primarily be. Now, in terms of, and that's kind of on the client acquisition, like revenue ops side, but in terms of operations, I think that what you're going to see, at least in the short run being the next few years, is you're going to see some big margin expansion for these professional service providers. And then I think you're going to see potentially like margin contraction. The margin expansion just being that the consumers of the services aren't switching to AI because they don't trust it. But whenever that time happens, then you're going to start seeing that compression come back in. So we're going to have a lot of operational leverage that we gain. And then we'll continue having that operational leverage, but it's going to be a fight to, retain clients, unless you, of course, go upstream. So that's the way that I'm kind of thinking about it. Now, that said, the other question is, who is better positioned to win the AI race, battle, whatever you want to call it? Is it somebody like my firm, or is it somebody like my firm? Is it a private equity firm, or is it somebody like a Deloitte, right? And so these larger firms obviously have a ton of cash to deploy, but then the question becomes, do you actually get the adoption? Mm-hmm. And I assure you, in these large partnerships, these larger CPA firms, you're not going to get the adoption. So what's going to happen is you're going to build these technology teams that just work around the partners, but that still is going to be more costly than what we might be able to do. At me as an 89% owner, I just get to say, you're going to do it my way, or you can get off my ship, right? And so we're going to have adoption. We're going to all do it the same way. But these larger firms don't have that. And so it doesn't matter how effective or efficient AI becomes. It doesn't matter how many hundreds of millions these large firms invest in AI. You will still have this partner who's 58 years old, 2 years away from retirement and does not want to change the way that they're doing business.
Right.
They don't
And
have
you're
the
going to have that
incentive.
times 1,000.
Yeah.
Hey guys, we want to take a quick break from the show just to tell you about our companies that make this happen. My name is Patrick Dichter and I own Appletree Business Services. We do accounting and tax nationwide. So if you own a small to medium-sized business, we'd love to help. And we can also do financial due diligence for any acquisitions. You can check us out at appletreebusiness.com.
And speaking of acquisitions, this is Clint, your co-host. My company is called Dealonomy. You can find us at dealonomy.com. We are on a mission to just make it 10 times easier to buy or sell a small business. If you're a buyer, you probably feel like finding a good business to buy is like searching for a needle in a haystack. We have created the Needle Store where you can just go find a great business that's turnkey, ready to purchase with banks ready to lend on it. Go find you a good one. Go buy it at dealonomy.com. And if you're a seller, we're the only place you can sell your business for no commission with a fast, free, guaranteed result. And so it's very innovative, easy button for buying or selling a business. Hope you join us at dealonomy.com.
All right. Thanks for supporting us. Now back to the show. Our pre-show, you mentioned you guys invested in some technology pretty heavily this year. Can you share what that looks like or what you're betting on?
Yeah, so we're building our own automation team in-house. We're using outsourced contractors to kind of help us with this. But we've developed our own software. So we've got a pricing software that we use for clients that we developed in-house. And what that does is it basically gives us insight into how much revenue we're going to do next year by November of the current year. So by November of this year, we can project with probably 5 degrees or 5 points of accuracy what the revenue is going to look like next year. And what that does is it gives us 3 months to staff the team if we need to make any changes. So we're getting pretty pinpoint accurate on the upcoming revenue and how to staff that team. But that's just a pricing tool that we developed internally. We also have a quality review tool because one of the things that we struggled with was, well, if we hold everybody to results, and in results is revenue produced, what if somebody's just producing a ton of revenue, but they're doing a really low quality job?
Yeah.
So we developed an internal quality tool that is essentially like works like the Airbnb rating system, where if you're the preparer, Patrick, and I'm the reviewer, you kick the return to me. I take a look at it. I kick the return back to you with my review notes. Then when you're done, we kick the return up to the manager. When we kick the return up to the manager, we both get a Slack notification that asks us to rate each other. It asks me to rate you on your quality, and it asks you to rate me on how I communicated the feedback to you. Was it good or bad, right? It's just 3-star system. And so when you do this across 2,000 data points, you can really start to see who's producing a high clip, but also at a high level of quality. And then we invest more time in those people. So we've got that. And then we've also got, so this automation team that's spinning up, they are implementing a lot of AI. We're building our own AI agents, and that's going to be firm-wide. That's a project that's literally starting next week. So very excited about that. I mean, we're just willing to throw money at any sort of technology to see if we can get any sort of efficiency gains. And we're very entrepreneurial about it. We really like pull all of our employees into the process. People recommend stuff all the time, and it's really cool to see. And I think they feel appreciated that like we actually take it seriously versus, I remember again what it was like at the big firms. You make a suggestion and then it's just into the black box and you never hear back. But for us, it's like, oh, wow, that's actually, let's do that next week. Let's not wait 6 months. Let's go and do this next week.
That's awesome, man. I feel like 80% of a professional services firm is like balancing capacity and hiring and just trying to skill up the junior to mid-tier folks. So
yeah,
you're solving that. Back on the whole M&A discussion, I think the other thing that's changed is partner path, right? Or the partner conversation, because before it was like, okay, my partners are going to buy me out. That's my exit, right? And now you have people willing to acquire a firm. So when you're talking to your team about partnership, is that just like have a seat at the table and you can buy your way in and you can make more money. And you're kind of pitching that. You're not pitching like, hey, one day we might exit, or what does that sound like at your firm to pitch somebody on becoming a partner?
Yeah. So at my firm, I am pitching one day we might exit, but I'm also caveating that with one day, you might want to exit, and we can just talk about what that looks like at that time. It's pretty squishy because I don't really know what the next 5 to 10 years really looks like for us. Aside from, I know that I want to keep building, and I know that I want to staff my leadership team with high quality executives. That just enables that kind of growth on autopilot. But beyond that, I'm not 100% sure. What I would like to do is avoid that traditional partnership model. I think that, so I get invited every year to go to this conference and talk about digital marketing. And so I always talk about like all the cool stuff that we're doing. And inevitably, one of the CMOs, these are CMOs. So the attendees are the CMOs of like the top 100 CPA firms. They all come to this conference and they learn about the different digital marketing trends. So I always talk about like what we're doing. And inevitably, one of the CMOs will raise their hand and say, that sounds great, but how do you convince the partner group that this is important? And I'm like, I have no idea. Like that is your problem. I don't know. I don't know how to guide you on that because I don't have that problem. The reason that problem exists is the way that the traditional partnership structure works. So the traditional partnership structure is you buy in and you work until you're 55 or 60. You get a forced retirement at that time. And your buyout, the way that they value it is they look at your last 5 years of compensation. They throw off the high year and the low year, and they average the middle three. They take the average of the middle three. And then they'll apply some sort of valuation to it, like 1.5 times, 2 times, 3 times, whatever that number comes out to be. They divide it by 10 years, and that's your annual payment for 10 years. That's your pension. Okay. And for partnerships, for the CPA firms, the theory was this makes perfect sense because if I'm paying a partner $1 million a year on average, and their payment becomes their total valuation is $3 million divided by 10 years. Well, that's $300K a year. So I'm clawing back $700K cash flow every single year, right? Yeah. That's the theory, the working theory. The problem that is embedded in this is if I know that I'm in my 5-year window, right? My 5-year look back window, I am not going to do anything that threatens my ability to earn money, right? Mm-hmm. So you want to talk to me about making the workflow more efficient? And by the way, we're charging hours. Yeah, okay. I'm not going to do that. Why would I make the workflow more efficient? Well, I don't care about your AI. I don't care about digital marketing. I'm set, man. I don't need more clients. I don't need any of that. So I'm not going to participate. I don't need AI because that's just going to make I'm going to have to work more. I don't want that. I can make $1 million for the next 5 years, and my buyout will be $3 million divided by 10 years. So that's the problem that comes with all these traditional partnerships. My goal is to avoid that problem. And I want to avoid that problem by structuring my partnership a little bit differently, potentially even switch into a C Corp type model, having a team of executives, having a bunch of shareholders. Like if you really think about just kind of like demystifying partnership in and of itself, you can really start thinking about how do you move equity downstream? Like why can't managers have some equity in the overall piece, like have some shares? Why can't the admin that's been there for 10 years have $100,000 worth of shares? And why can't you offer some liquidity every single year so they could choose to sell or stay in? Mm-hmm. I think that you can do those things if you're growing a firm like a traditional business would grow. I don't think you can do those things if the partners are charged with business development and if the firm itself just kind of acts as like a cost sharing business, which is what all these businesses are. Yeah. I don't think you can do that. So I'm trying to think about it a little bit differently.
Interesting. I'm excited for you to kind of lead the charge on that. I feel like
it's either going to be awesome or it's going to fail terribly. So which is typically my life. It's like it's phenomenal or it really sucks.
Well, I feel like part of the M&A success recently is because some of these partners they have another option now and they can sell out versus like having their junior people buy them out. I think this whole question of like, is this the top or is this the window? I think there was a big platform that happened recently in the past couple of months. I don't know if you saw this, but Acuity got bought by a big group and they were the platform. And then they bought a bunch of other firms, and immediately this became like a top 30 firm with all these acquisitions that they did. And so
Soren, I think, right?
So in the same way in HVAC, there'll be these like people that move the goalpost up, you know, if that acquisition goes well, I think, you know, that moves it up for some people, or it might, you know, pour some cold water on the valuations. But
yeah, well, it's kind of funny because back in 2020, 2021, like I wrote out this thing to my COO, Blake, and I was like, hey, my goal is to basically build like the Procter and Gamble of CPA firms. So I want to buy these additional firms, bring them on, but let them keep their brand. And then we'll build it in our back office and really help them scale up. And so seeing Soren do that, I was like, dang it. And then there's another company, Ascend, is doing that too. I was like, that going in, like, these guys just have the money. I don't have money yet.
Yeah, I think Ascend is part of the really, really big PE group.
Yeah, they are. Yeah.
I'm blanking on the name, but yeah. So interesting. So what we're hearing is you got 8 more years of gas in the tank. And
we'll see.
Not quite ready to sell.
Depends on how I can structure it. Like I can genuinely see myself building a ginormous firm and acting more as this like high level CEO or even like board of advisors to it, and just always being in the game.
What if one of these players came to you today saying we can do that right now, you know, and said, what if instead of that $27 million check, what if we write you a $15 million check and we buy into your firm and we let you start playing with our money to build your Procter and Gamble of CPA firms with us, and be a capital allocator and do M&A and be a leader with us? Is that something that like, because I'm sure we may even get someone, you may have someone doing that right now with you. Like they approach you with those types of pitches too. Let's do a recapitalization here. What do you think about that type of approach?
So that has happened. And I always get to the point of I'm giving up too much upside. Yeah. So because again, for me, it's like if I was 45, that would be extremely attractive. Yeah. If I'm 34, I've got a long runway. And so it's just a matter of, you know, the growth.
So let's stay on that personal thread for a second. We've had a great business conversation, but like the stereotype of a CPA firm owner is that you're kind of like, especially during the busy couple seasons a year, you're overworked. It's hard to spend the time with your family. You've got these young kids, these years with the young kids, you never get back, you know? And like, do you feel like you've reached enough scale that you've got leaders in place and you're able to have the work-life balance that you want right now, and that's what's helping you stay the course here?
Yeah. I would actually argue that it might not be helping me stay the course.
Yeah.
It gives you kind of too much time to sort of think about all the options, you know? So this is actually this is a topic that I have coached and written content about just for the CPA industry too. I think that there's this working theory that you can be a solopreneur and make 400 or 500K and have work-life balance. But the reality is that when you're a solopreneur and that's what you're doing, you know, you've got 200 bosses essentially. Like you can take a vacation, but if one of your clients needs you, you got to drop everything, and you don't ever have a true work-life balance. Like you don't have the true freedom that you think that you do. And so what I've tried to educate people on is, hey, if you try to build a real CPA firm, like not like a traditional CPA firm, because those owners and leaders, they don't have any work-life balance either. But if you build a real business, then you as the owner and your executives as well, you guys should be getting out of client work to spend more time working on the business. And when that happens, this certain pressure and demand on your time goes away, and it just allows you to build more structure into your day-to-day so you can drive that work-life balance that you're looking for. But a lot of the owners will see that shift from like, man, I'm just getting pulled in a million directions. I've got a ton of client work that I have to do, to, wow, this is starting to feel a lot better and I've got more control over my time and I can take a day off and not have to worry about it. start to see that shift around $4 to $5 million in revenue, because by that point, you've got enough cash flow to invest in a leadership team, and really bring on the higher level people that you need to help you run the day-to-day operations. And so as soon as you can start doing that, you can start building the flexibility that you're looking for. So for me, yeah, it's very flexible. Even during busy season, it's very flexible. I try not to talk about that a lot because I don't want anybody on my team to be like, oh, well, what is he doing every single day while I'm cranking on tax returns? And believe me, I say that as somebody that cranked on tax returns for years, every single weekend, every single holiday, never a break. But the flexibility is kind of interesting for me, because anytime that I get more flexibility than I bargained for, I start questioning, what am I supposed to do as a CEO? Right? Like, what is the next thing for me? And that started happening Q1 of this year, which has kind of led me down this M&A path. Okay, the real estate vertical is pretty much locked in at this point. So what's next? What's the next thing that we're going to add? And that's been just an interesting exploration. But last week I took a vacation and I checked my email like one time. So that's a first. I think that you can build the flexibility as an owner. And I think that the larger that you become, ironically, the more flexibility that you can ultimately build and the more freedom you can ultimately build, which is why I say, like, I genuinely believe that over the span of 10 years, I could probably build a $100 million company, place the right executives, and it could be a pretty passive asset at that point that provides a lot of growth opportunities for everybody involved while simultaneously letting me live the life however I want to.
Yeah.
So.
Well, I like to stay on this personal thread for a minute.
Sure.
I'd love to just get your take on like your relationship with money and wealth.
Sure.
Because I think that I love having the conversations with folks at your stage, because I think there's this almost like this threshold you cross. And I think it's somewhere around like when you could clear after taxes somewhere in the 8 figures on a sale of a business. There's almost no argument that can be made that you need more money, because like
Right.
if you conservatively invest 10 figures of a nest egg type of wealth, you can make an incredible income forever, and kind of be set for life type of money. And so I love hearing from people that are like in that position where I'm like, realistically, you could achieve that with 2 different ways, with a 100% sale or with a recapitalization sale where you join another firm, and you could kind of personally set your family up for kind of easy street-ish, where you can just kind of do whatever you want for the rest of your life. I know, and I'm not imagining sitting on a beach, because like no entrepreneur ever does that. Like that's unrealistic. But you would be able to like, choose work or not work, projects you're passionate about, not passionate about, just kind of do whatever stimulates you and not be locked into one thing, and have complete freedom and autonomy, by a capitalization event. And so like, I guess for me and others that like, we've never even like, I didn't come from that type of background where I had that type of financial freedom or wealth. And it's always been almost like this, unicorn you're chasing. And I'm not at that point yet where I could say I could realistically pull a lever and change my life forever like that. So I've never had to face that temptation. Like, how do you, what's your relationship like with money where it's like, it doesn't seem like you're that fazed by that? And like, why doesn't that thought process haunt you or phase you of like, this would be my chance to be set up for life and I could still do whatever I want after that?
I would say it used to, like definitely, my perspective has shifted a lot probably within the last 3 years. Prior to that, it was definitely like, okay, I need to be able to build this to something where I can cash out and just live on passive income. But as that, as I've kind of arrived at that trigger point, so to speak, it's really just like, what's the point? I'm happy doing what I'm doing. I'm having fun. I'm making enough money. Having $10 million in the bank, that would be great. But then what? Like, do I become a stay-at-home dad? Like, don't get me wrong, love my kids, but to your point, like that just wouldn't necessarily drive me on an ongoing basis. So I don't know. I think part of it's just like what would be next. Part of it's I don't need the cash. I've done a really good job investing my after-tax cash and being very thoughtful about it. So I've got a decent nest egg already built up. So worst case, like I'd still be fine. Even if the business just imploded tomorrow, I would still be fine. So
is that what's helped you overcome like because I think what holds people back sometimes is like fear, or like, or like if I don't do this now, I may miss my chance to ever achieve that. And so you think it's been like kind of keeping your lifestyle in check, investing well outside the business, so you're not like completely beholden to a liquidity event. You think that's helped you get that confidence to be able to stare down that temptation?
I think maybe what it is like, don't get me wrong, like I splurge every once in a while on things that are totally unnecessary. I have a big house, expensive house, but I think it really kind of like being in this house, so we built this house last year and we moved in. It's probably like 6 months we were living here, and I was talking to one of my coaches and I was just like, dude, like it's just a freaking house, man. It's just like, it's not even that big. It's just a house. Like, I don't care. Which is bizarre to say. And I also understand how privileged I am to say that. But I think my relationship with money is just like the next $100,000, the next $500,000, the next $1 million is not going to change my life. I don't want a private jet. I always told myself I wanted one to like have a goal to drive for, but like the reality is I don't want one. The only like big splurge thing that I would like to do one day is buy an Audi R8, but like I don't need to sell my business to do that, So I think I'm good. Like I'm good on the things. I'm good on the trips. I can cover all my expenses fine with some cushion, so I'm good. And so then the question is just like, well, what does selling really do for you? And I think that it's something that I have explored pretty thoroughly, because I do want to make the right decision for my family. You have to be able to protect your family and set them up for success long term. And so then you start weighing, okay, well, what are the risks over the next 5 to 10 years? If we built this to $100 million of revenue and we were able to maintain a 15-20% EBITDA, what does that look like versus selling right now today and being able to cash out $12 million or $15 million, whatever it is. And so those are the different scenarios that I kind of play in my head. It's very much like, I believe I'm capable of building this into something larger. And I believe that the risks are lower than, maybe what the market perceives them to be, with a professional service firm. So if I was running a different type of business, I might pull the trigger, but a professional services firm, like I feel like it's pretty hard to blow up. And so as long as we continue to grow and as long as I continue to have fun in the process, I don't really see a reason to pull the trigger and cash out.
Yeah.
I don't know if that really answered your question.
No, it does. That's perfect. That's the perfect answer. And in fact, I would love to just sum that up for the listeners out there that are acquirers. When you're approaching someone like Brandon, I think a big mistake is they think the multiple or the bag of money is the thing that can get you his company, or get you this. But like I've asked him a half dozen different ways on the show to try to tempt him that way, and I can't get him. Like I can't win him over with it. And when we peel back the layers of that onion, what really makes Brandon tick is not that. It's the growth, it's the challenge, it's the personal reasons. And so like, unless you have tapped into a big why, especially for a mid-career person that's not staring down being 60, 65, 70 and just feeling like I can't keep doing this forever, then like the way you partner with a Brandon Hall is you have to tap into something personal, not financial.
Yeah.
There has to be some personal like if he's having fun and he's being challenged, he would have to believe he would have more fun and be more challenged if they were working with you, or did a deal with you. And if you can't get there in your initial conversations or your coffee or your lunch meetings, of just kind of painting a vision of what a new chapter of life that would look like, that would be more fun, more challenging, more stimulating, then like you're dead in the water. Like your offer isn't going to move that. And so that's my lesson learned here. And I've heard that from other folks too, but I think today's show is especially relevant to that conversation. Is that's what it takes. You have to tap into that big why, and it's not the zeros and the commas that's going to get you there.
Well, I'll give you some more context too for any of the acquirers listening. So one thing that is important to me is what I was talking about earlier, is finding a way to economically, that's the challenge, right? Economically push equity downstream. And that's important to me because I like creating cool stories that this industry hasn't heard about or thought about before. There is a private equity company, Ascend, doing that right now. And they allocate equity units based on each of their acquired firms' performance every year. And then those firms can distribute those equity units to anybody on the team, which is really cool. But something like that would be a more interesting conversation for somebody like me versus like, oh, well, if I give you $30 million, would you take it? Because at the end of the day, it's like, sure, like I could take it, but then I genuinely feel like I'd be doing everybody in my firm a disservice. And while I would be set up for success, and while my family would be set up for success, now my whole team has to go and figure out what's next for them. And that's the reality of selling a company. I'm not blind to that. At some point that will be the case, but how many success stories can I create in the meantime? Is it just going to be me and one, or is it going to be like 100? I think the founder of Spanx, right? Wasn't it Spanx? Yeah. She sold and made all of her team a millionaire. And, we're not going to get those crazy valuations for me to do that. So if anybody on my team's listening, just economically, it's not going to work. But it's those types of things that I think about too, in the background as I'm kind of considering these different paths that you can take. So to your point, it's very much, you got to tap into something a little more personal. Like, what are the real motives behind wanting to continue working versus liquidating?
A lot to juggle and think about, but it's awesome that you're wanting to bring your team with you along the way. So this has been a really fun conversation. I feel like we could go for a while, but if people want to connect with you online, Brandon, where's the best place for them to do that?
You can follow me on Twitter, Hall CPA, or X. You can also hit me up on LinkedIn. Brandon Hall CPA. I actually don't know what my handle is, but you can search me and you can connect with me there. You're also welcome to email me. My email is brandon.hall@hallcpallc.com. Either one of those three channels will be good. I will admit I'm not really on X as much as I used to be. The algorithm platform changes just kind of made it not worth my time compared to other options to continue pushing out content on X. But yeah, you can still hit me up there, and I'm still kind of active in the DMs and stuff. So, okay, cool. We'll link to that in the show notes. But this has been awesome having you on, man. Congrats on all your success and that third baby, and we'll be in touch here soon. Thanks, guys. This was fun.
Thank you very much, man.